Welcome back to the Deep Dive. Our mission today is to take a pretty complex stack of investor filings, earnings calls, and some dense strategy papers, and turn it all into a clear, actionable understanding of a major player in enterprise security. We are taking a hard look at Qualys, Inc. That's ticker QLYS.
And we're doing this because of a very specific, a very high conviction move from a globally renowned investor.
Right.
I mean, we often focus on the flashy hypergrowth names in tech, but Qualys is a veteran. It's a profitable, established giant that recently caught the eye of Terry Smith.
And he didn't just nibble, did he?
No, he made a significant capital-heavy increase in his position.
Okay, let's unpack this then, because this presents a bit of a paradox right out of the gate.
It really does.
Qualys is a company known for stability, for cash generation, but also, historically, for slowing revenue growth. So what exactly is Qualys building now? Why is this specific investment move so noteworthy at this particular moment?
Then what does their recent Q3 2025 performance tell us about the future value of that conviction?
Exactly.
Our mission is to understand why a company with revenue growth hovering around, 10% is attracting such strong capital allocation. We have to go deep into their strategic pivot. They're actively trying to shift the entire definition of their business.
From what to what?
From traditional vulnerability management, which is a mature, crowded market, to pioneering a new field they're calling risk surface management. And it's all powered by something they call Agentic AI.
So Smith is buying a stable value stock.
Right.
But he might also be getting an unpriced high-growth call option baked right into their existing customer base.
That's the thesis we need to explore.
Okay, let's start with the hard data that brought Qualys to the forefront. The specific investment action, our catalyst for today. We're looking at the 13F filing.
Terry Smith's latest moves.
And this wasn't just some minor portfolio rebalancing. This was a statement.
It was a definitive signal, and the scale is really important here. The specifics of the filing showed that Terry Smith increased his stake in Qualys by exactly 152,257 shares.
In the last quarter.
In a single quarter. And when you look at his existing position, that represents a substantial addition of over 21%.
21.19%. I mean, that's a massive percentage increase for an investor who's known for long-term, low turnover holdings.
It is. It's not a trade. It's a conviction build.
So an increase of over a fifth of the position size. What does that actually look like in terms of the fund's overall holding and commitment to Qualys?
Well, the fund now holds a total of 870,859 shares. And if we look at the price around the time of the filing, roughly $143.59, the total value of that holding is sitting at approximately $115.2 million.
Wow.
But more critically, this single action raised Qualys' portfolio weighting by 10 basis points.
Okay, 0.1%.
Right. And in the universe of a massive global fund, a 10 basis point increase in allocation isn't done lightly. The sources we have describe it precisely as a meaningful increase in conviction.
And that phrase, meaningful increase in conviction, that is the signal we have to decode. Terry Smith is not a momentum investor.
Not at all.
He's famous for his buy and hold philosophy. He focuses almost exclusively on businesses that are high quality, have durable competitive advantages, and are profoundly cash generative.
He's hunting for stability, high return on invested capital, and strong pricing power.
So when an investor with that kind of stringent philosophy makes a move this aggressive in a mature technology company, what does that signal?
It signals confidence that Qualys possesses two things. First, an enduring, durable business model that guarantees reliable future cash generation, even when facing a ton of industry competition.
Okay, the foundation is solid.
And second, that the risks associated with its strategic pivot, this whole shift we're about to discuss, are outweighed by the potential rewards, particularly when you look at capital efficiency and the returns that cash can generate.
It's the classic value investor approach to a growth sector, isn't it?
It is.
They aren't paying a hyper-growth multiple, but they're confident that the underlying quality of the asset provides stability, safety, and a reliable return on capital.
He's essentially betting that Qualys is a cash machine.
And the new growth strategy is?
It's the bonus. It's the upside. He believes the company's strong history, its embedded position within its customer base, and those high margins give it enough time and resources to execute this complex technological shift they're undertaking.
Unlike a lot of their competitors.
Unlike many competitors who are just burning venture capital cash to stay afloat.
So let's move past the investment signal and dive into the nuts and bolts. What is this stable, profitable, underlying business that generated this conviction in the first place?
Well, to really understand the future, you have to establish the foundation. And Qualys is, as we said, a veteran in the security space.
Identity and history first. Where did they come from?
Qualys was founded way back in 1999.
Wow, okay.
Yeah, that places it firmly among the pioneers who realized security could be delivered over the internet. They were one of the first companies to truly adopt and scale the software as a service, or SaaS, model for enterprise security.
And they're based in California.
Headquartered in Foster City, California. They initially established their reputation as really the undisputed leader in vulnerability management, or VM.
Right.
Today, they market themselves as a leading provider of comprehensive cloud-based IT, security, and compliance solutions.
And that SaaS engine is the root of their financial resilience, isn't it? It's why they generate the kind of cash that an investor like Smith loves.
It is the absolute bedrock. The business model is entirely built on recurring revenue from renewable annual subscriptions to their suite of cloud applications.
And this structure, it gives them some key financial advantages.
Several. The most notable is their, frankly, enviable gross margin profile. Historically, their gross margins have consistently hovered around 78 to 80%.
Which is already elite.
It is. But they recently pushed even higher, impressively hitting 85% on a non-GAAP basis in Q3 2025.
85% non-GAAP gross margin. I mean, that is essentially software purity. The cost of goods sold is so low, which means almost every single revenue dollar drops straight to the gross margin line.
It's premium territory for any technology business. It speaks to phenomenal operational efficiency.
And there's more, right? The upfront payments.
Yes. Because customers pay for these annual subscriptions upfront, Qualys immediately books significant amounts as deferred revenue on its balance sheet.
Which is a liability, but it's a good kind of liability.
It's the best kind. This deferred revenue acts as a crucial safety cushion. It provides exceptional visibility into the near-term income stream, which, again, provides the very stability that investors like Smith prioritize.
So the stability is clear, but growth requires sales execution. They rely heavily on the classic land and expand model. How successful are they at executing that expand lever today?
Well, their growth relies on two motions. First, acquiring new customers, which is, increasingly costly and difficult in this competitive environment.
Sure.
Second, and this is absolutely critical to their pivot, is expanding the relationship with their massive base of existing customers.
How big that base?
Over 10,000 subscription customers worldwide, including a majority of the Forbes Global 100.
So the expand motion is about cross-selling more modules into those accounts.
Exactly. The success of this whole ETM pivot we're going to talk about hinges entirely on their ability to sell more deeply into those existing accounts.
And what allows them to cross-sell so efficiently? It has to be the core tech, the backbone that lets them collect all this data without a massive integration headache for the customer.
Precisely. The core technology is the Qualys Enterprise TrueRisk platform. It's a globally distributed cloud architecture operating out of 14 shared cloud operations centers.
And the crucial strategic asset here is the unified data collection, right? The single agent.
The single lightweight agent, yes.
Let's focus on that for a second. Why is that one piece of software so strategically important compared to competitors who might need multiple point solutions?
Because that single agent is their eyes and ears. Once you deploy it, it continuously collects all the critical security intelligence you need. Vulnerability data, configuration data, asset inventory across the entirety of the customer's complex hybrid environment.
So it doesn't matter where the asset is.
Doesn't matter. On-prem, in a public cloud like AWS or Azure, on an endpoint device, or running as a container, the same agent collects the high-fidelity data.
And that unification, that's the key.
It radically simplifies deployment, it reduces operational friction for the customer, and most importantly, it provides Qualys with a unified 360-degree view of the customer's entire security posture.
Which is the perfect foundation for cross-selling.
And for the strategic pivot.
So we've got the foundation, a stable, high-margin, single-agent SaaS platform. But the vulnerability management market is mature, which is what led to that slowing growth we mentioned.
Right.
And this brings us directly to the strategic transformation they're undertaking right now.
The cybersecurity market doesn't stand still for anyone. Qualys is highly profitable, but that profitability is only sustainable if they accelerate innovation. So their core strategy is this profound pivot. They're shifting the philosophical focus from simply identifying the attack surface,
Which is what traditional VM does.
Which is what VM does, right? To this new proactive concept of risk surface management, or RSM. And this whole motion is leveraging proprietary agentic AI.
This sounds like more than just a marketing phrase. It signals a move away from just providing security checklists
Yes.
and toward providing actual business intelligence.
It absolutely does. The CEO, Sumit Thakar, has said over and over that the biggest complaint from CSOs isn't that they lack data, it's that they lack the ability to prioritize and quantify risk in terms that matter to the boardroom.
In dollars and cents.
In business impact. And the flagship solution addressing this is the Enterprise True Risk Management, or ETM, solution.
And this is the product line that Qualys believes will fundamentally change their growth trajectory.
Yeah.
How is ETM different in a very crowded market?
ETM is unique because it unifies three critical but traditionally separate security functions into a single workflow.
Okay, what are they?
First, there's cyber risk quantification, CRQ. That translates technical vulnerabilities into measurable financial or business impact.
So this bug could cost us X million dollars.
Exactly. Second is continuous threat exposure management, or CTEM, which constantly maps out where an organization is vulnerable.
And third.
Third, and this is key, is native remediation operations, meaning the solution doesn't just send an alert, it automates the fix.
So instead of a security team using one tool to find a vulnerability, passing it in a spreadsheet to another team to assess the business impact, then manually telling a third team to go fix it.
ETM unifies that entire loop. Precisely. The objective is to stop trying to fix everything, which is an impossible task, and start fixing the handful of risks that matter most, quickly, and at massive scale.
It aligns the security decisions directly with measurable business priorities. That's the pitch to the CSO.
That's the pitch.
Now, a critical part of this ETM solution is that it's vendor agnostic. It's not just using Qualys' own data from its agent, is it?
And that's one of its key differentiators against the big platform giants. ETM aggregates and correlates intelligence from both Qualys data and crucial non-Qualys third-party sources, like endpoint data from other vendors or security information from cloud providers. This positions ETM to act as a vendor-agnostic orchestration layer. It helps customers simplify their environment without forcing them to rip and replace every single non-Qualys tool.
Which dramatically lowers the barrier to adoption.
Hugely.
So ETM is the product, but the long-term vision is what they call the Risk Operations Center, or ROC.
Yes, this is the new category they were trying to pioneer.
We need to clearly define the difference between a traditional Security Operations Center, a SOC, and this new ROC concept.
The distinction is crucial. The traditional SOC is inherently reactive.
It's looking for things that have already happened.
Exactly. It focuses on detecting breaches after they happen, monitoring network traffic, looking for signs of compromise, responding to alerts. The Qualys Agentic AI-powered ROC is designed to be fundamentally proactive. Its job is to centralize the response to threats pre-breach.
So it's about detecting exposures and vulnerabilities.
And responding at machine speed before an attacker can actually exploit them.
Okay, let's spend a minute on the term Agentic AI workforce. That's a massive buzzword. How does Qualys define agentic in a way that's different from just simple AI-powered alerting?
It's a good question. If you think of traditional AI in security, it often acts as just a better analyst. It detects patterns, flags anomalies, generates a high-fidelity alert.
Right.
Agentic AI is different. It refers to software agents that can operate autonomously. They make decisions, they initiate actions, and they perform complex multi-step tasks without human intervention.
So in the ROC.
In the ROC, this agentic AI workforce leverages their True Risk framework and TrueLens capabilities to move autonomously from discovery through risk assessment to finally initiating remediation.
Including integration with other systems.
Full integration with external IT service management systems like ServiceNow.
So it's not just a warning light. It's an automated security engineer that can discover a critical vulnerability and implement a compensating control in minutes, maybe while the human security team is asleep.
Exactly. It closes the loop. This ability to normalize petabytes of data and then execute the remediation steps, the action piece at machine speed, is the core differentiator Qualys is hanging its future growth on.
To make this proactive approach real, they need tools that get rid of the uncertainty. You mentioned two core differentiators, TrueConfirm and TrueRisk Eliminate. Let's start with TrueConfirm. What problem is that solving?
TrueConfirm solves the massive problem of alert fatigue and false positives.
Hmm.
In most environments, only a tiny fraction of identified vulnerabilities are actually exploitable because of various system configurations.
And security teams waste a ton of time patching things that don't matter.
An enormous amount of time. TrueConfirm is a pioneering capability that removes this guesswork entirely.
How does it do that?
It runs safe, controlled exploits over the network to confirm exploitability before the customer is compromised. This automated validation at scale closes the gap between theoretical exposure and actual risk.
So it allows customers to be laser-focused on prioritizing only the risks that an attacker could actually breach.
Which translates directly to massive efficiency gains. If you're a CISO, this saves you thousands of hours of unnecessary, costly patching cycles.
That makes a ton of sense. So once the risk is confirmed, you have to eliminate it. That brings us to True Risk Eliminate, and specifically how it tackles what you call the unpatchable gap.
Right. True Risk Eliminate is the final crucial step in the ETM workflow. And yes, it automates the deployment of standard patches, but its real competitive advantage is closing that unpatchable gap.
What kinds of systems are we talking about here?
Think legacy manufacturing machinery, critical embedded systems in a hospital, or certain regulated environments where applying a patch is either too risky because it might break the operation.
Or a patch just doesn't exist yet.
Or a patch just doesn't exist yet.
And what does it do in those situations?
It automates an array of what are called compensating controls. So instead of waiting for a patch, TrueRisk Eliminate automatically implements network segmentation or configuration hardening or microsegmentation policies, actions that neutralize the attack path without requiring a full system patch.
I see.
It's this comprehensive AI-based automated remediation umbrella that Qualys sees as the critical adoption lever and the key to its future pricing power.
So let's bring this all back to the financials. Has this ambitious strategic pivot actually started converting into real sales potential, justifying that Terry Smith conviction?
Yes. The initial signs are promising. The enterprise True Risk Management solution hit general availability about 9 months ago.
And the traction.
Management reported converting over 28 high-value proof of concepts to commercial deployments. But more importantly, they've quantified the financial upside.
What are they saying?
Management explicitly stated they expect ETM to drive a potential uplift of up to 100% on every dollar of VMDR their traditional vulnerability management revenue.
A potential doubling of contract value from their flagship solution just by cross-selling ETM.
Yes.
That is the core financial insight that drives the conviction in this stock, even with the moderate overall growth rate.
It is the roadmap for growth reacceleration. The promise of ETM integrating third-party data and automating that remediation loop fundamentally transforms their business from a niche VM vendor into a critical, high-value orchestration layer.
It makes the platform stickier.
Significantly stickier, and it substantially increases the total addressable market within their existing customer base.
The strategic vision is compelling for sure. But Terry Smith is known for trusting the balance sheet over the press release. So let's look at the recent Q3 2025 results. Did the numbers actually validate his deep commitment, or do they hint at some operational struggles?
The Q3 results tell a story of exceptional stability and efficiency, which is exactly what a quality investor demands. The top line grew, but modestly.
Give us the top-line snapshot for Q3.
Revenues grew 10% year over year, reaching $169.9 million. The company raised its full-year 2025 revenue guidance slightly, maintaining a steady 10% growth rate.
Okay, stable, but as you said, it's lagging the 25% plus growth we see from next-gen competitors.
It is.
And here is where we need to talk about the friction point. The growth is moderate, and a key metric for any SaaS company is the net dollar expansion rate.
Right, the NDE.
You just said ETM could double contract value, yet the NDE rate held steady at 104%, which was unchanged from the previous quarter. That sounds like a significant execution challenge on that expand motion so far.
That is the critical tension in the Qualys investment thesis. It's a great point. If ETM offers 100% uplift, why is the NDE rate still stuck at 104%?
What's the thinking there?
It implies two things. First, the ETM solution, while promising, is still really early in its ramp-up cycle. The Q3 results captured the initial commercial deployments, but not a full-scale rollout across the whole customer base.
Okay, so it's a timing issue.
Potentially.
Yeah.
And second, it suggests that outside of ETM, the expansion motion in their other modules like EDR or Total Cloud is challenging because of that fierce competition we talked about.
So this is dragging down the average.
It's slowing the overall average expansion rate. The 104% NDE means that any real growth acceleration is dependent entirely on the successful, rapid scaling of ETM adoption.
That makes the ETM bet even higher stakes. But let's look at the other side of the business, the side that Terry Smith is explicitly paying for, the exceptional profitability and efficiency.
This is the real story. As we mentioned, the non-GAAP gross margin reached a stunning 85%.
Up from 83%.
Right, but the efficiency extends deep into the cost structure. Adjusted EBITDA was $82.6 million, resulting in a tremendously strong 49% margin. That's up from 45% a year ago.
A 49% EBITDA margin in a business growing at 10%. I mean, that is a fortress. Their operating leverage is nearly unmatched in this sector.
It speaks to extreme capital efficiency, and this efficiency translates directly to cash flow generation, which is arguably the most powerful metric for Qualys.
What did that look like in Q3?
Operating cash flow grew 48% to $90.4 million in Q3 alone. This represents a remarkable 53% cash flow margin.
53%.
Compared to 37% just a year ago, this level of cash generation, coupled with relatively low CapEx requirements, means Qualys is a true cash machine.
53% cash flow margin? I mean, that is a staggering figure, especially compared to growth companies that reinvest every single dollar back into sales and marketing. This leads directly to the core of their capital allocation strategy.
Yeah.
What do they do with all that cash?
They return it to shareholders. Management is extremely clear that large-scale share repurchase is a core function of their balance sheet. In Q3 alone, they spent $49.4 million repurchasing 366,000 shares.
And the cumulative total?
Since starting the buyback program in 2018, Qualys has returned a cumulative $1.2 billion in cash to shareholders.
$1.2 billion returned to shareholders. For a patient investor like Smith, this is incredibly appealing because it provides immediate, predictable value creation by reducing the share count and boosting earnings per share, regardless of what the market is doing. They're a capital return machine disguised as a cybersecurity vendor.
It provides a floor beneath the stock and ensures that their massive profits translate directly into shareholder value, which makes that moderate growth rate far more palatable.
Okay, let's shift to the operational wins that prove the strategic pivot is not just a theory.
Right. The channel strategy is flourishing. Channel partners now make up 50% of total revenues, up from 47% a year ago.
And the growth there is faster.
Much faster. Revenue through those partners grew 17%, which significantly outpaces their direct sales growth of just 5%.
And that partner-led motion is key for selling complex platforms like ETM.
Essential, especially to mid-market and international customers.
And speaking of international, those markets are responding faster than the domestic one.
Correct. International revenue grew 15%, which was well ahead of domestic growth at 7%. This suggests the platform's value proposition, simplicity, consolidation is resonating well in regions that are maybe less saturated by US-based high-burn competitors.
Let's talk about the new pricing model they're using to accelerate platform adoption. QLYS.
QLEX is a flexible platform pricing model that was beta tested in Q3. It's specifically designed to eliminate the friction involved in buying multiple modules one by one.
So it's an incentive to commit to the whole platform up front.
Exactly. And they immediately saw success. They had a Global 10 customer make a multi-year commitment under QLEX, which resulted in a more than 50% increase in their annual bookings.
And they adopted new modules.
Several new modules. This is proof that the unified platform strategy, when you price it correctly, can successfully drive that crucial expansion motion.
The individual customer wins also provide critical evidence that ETM is solving complex problems. Tell us about the Global 700 upsell.
This customer initially used Qualys only for a very specific, limited use case PCI scanning.
The compliance checkbox.
Exactly. But like many large organizations, they were drowning in tool sprawl with siloed risk signals from various point solutions code, endpoint, cloud, container data. They chose Qualys to transform these fragmented signals into a cohesive, real-time risk management solution.
And this wasn't just an add-on, it was a full consolidation.
It was a massive upsell and consolidation. They replaced their existing traditional vulnerability management vendor entirely. They bought 3 additional Qualys modules, including ETM, explicitly to start operationalizing their risk operations center.
Using data from third-party tools as well.
Right. And this deal resulted in a mid-six-figure annual bookings upsell and immediately opened the door for them to evaluate Total Cloud CNAPP and True Risk Eliminate for future purchases.
It's the land and expand thesis accelerating.
It is.
And the federal consolidation win highlights their strength in highly regulated environments.
Yeah, this showcases their scalability and regulatory compliance strength. A large government agency seeking to streamline its security spending accelerated the consolidation of its entire security stack. They needed a FedRAMP, high-authorized solution.
And they chose Qualys' single-agent platform to replace multiple legacy and next-gen point solutions. How extensive was this consolidation?
They consolidated across 17 distinct Qualys modules.
17.
17, including VMDR, ETM, Total Cloud, True Risk Eliminate, and Total AI. They're now leveraging a unified dashboard to manage a vast array of risk management use cases.
And that kind of seven-figure multi-module consolidation win proves that Qualys can compete and win against both legacy vendors and newer solutions, especially where platform integration and compliance are the top priorities.
So that financial stability is the floor, but the competitive dynamics, that's what determines the ceiling. Qualys operates in a market that isn't just competitive, it's profoundly cutthroat. And this pressure is the fundamental reason their growth rate has decelerated, forcing them into this aggressive platform acceleration.
Okay, let's establish the competitive context. The industry itself is just exploding, fueled by complexity and this desperate need for consolidation.
The global cybersecurity market is projected to nearly double in size, growing from about $273 billion in 2024 to $600 billion by 2030.
That's a huge KGR.
About 14.5%. And this enormous growth is driven by complex multi-cloud adoption, the rise of sophisticated ransomware, and critically, the sheer operational cost of tool sprawl.
Where CSOs are managing dozens of siloed, poorly integrated point solutions.
Exactly. The market trend is clear, consolidation is necessary, and unified platforms are going to win.
So who are the key competitors Qualys is fighting against day to day? How do their strategies differ?
You can really categorize them into four major groups, each attacking Qualys' market share from a different angle. First, you've got the direct VM rivals like Tenable and Rapid7.
Head-to-head on vulnerability management.
Right. Second, you have the EDR/XDR leaders, think CrowdStrike and Sentinel, who started at the endpoint and are aggressively expanding their single agent into VM, cloud security, and identity.
And then, of course, the formidable giants.
Exactly. Third, the broad platform giants like Palo Alto Networks and Microsoft. These pose the largest competitive threat through aggressive bundling, leveraging their massive enterprise presence. And fourth, you have the specialized cloud-native players like QLYS and Orca Security who are focused on that high-growth CNAPP space.
The competition from CrowdStrike and the platform giants is what's keeping Qualys' top-line growth at 10%. So how specifically are the EDR leaders like CrowdStrike encroaching on Qualys' core turf?
Well, CrowdStrike, for instance, has successfully leveraged its ubiquity on the endpoint where its agent already lives to integrate vulnerability management capabilities seamlessly into its high-growth platform.
So they offer a unified agent approach too.
For EDR, threat intel, and VM. They make the argument to CISOs that consolidating these functions on one platform simplifies operations and saves cost. This is a direct competitive challenge to Qualys' single-agent VM dominance.
And the platform giants, Palo Alto and Microsoft, they leverage financial might and, ubiquity.
Yeah.
How does their bundling strategy threaten Qualys?
It's a major threat. Microsoft, for example, can bundle a comprehensive suite of security tools, including VM and cloud security, into its massive E5 licensing agreements at virtually zero marginal cost.
And for a customer focused just on cost savings, that can be good enough.
It can sometimes be good enough, threatening to displace a specialized vendor like Qualys. Palo Alto Networks employs a similar strategy, acquiring specialized companies and integrating them into a broader platform, competing directly with Qualys' total cloud offerings.
Okay, so given this intensely competitive dynamic, what are Qualys' core durable advantages? The things that justify its premium margins and that Terry Smith conviction?
The first has to be their superior profitability and financial health. Qualys maintains significantly higher GAAP operating profitability and free cash flow margins compared to even its direct rivals like Tenable and Rapid7.
They're just more cash efficient.
Far more. And this financial fortress provides resilience and allows them to fund R&D without relying on debt or equity, unlike so many of their high-growth peers.
Okay, and the second advantage is the integrated architecture.
They have incredibly strong brand recognition in VM and compliance. They are the incumbents in thousands of high-value accounts, combined with the power of their original single-agent cloud platform.
Which makes cross-selling new modules, especially ETM, far easier.
Far easier than if they had to deploy a brand new agent for every single function. Their architecture facilitates expansion naturally.
And the third major advantage, tied right back to Smith's interest, is that cash position and capital return program.
That robustness allows for continuous, high-quality R&D investment in areas like Agentic AI, and at the same time facilitates that huge capital return program.
A dual strategy.
It is. It appeals directly to investors seeking stable returns in a volatile sector. They offer downside protection through cash flow, with upside potential if the strategic pivot works.
However, the sources are clear that they face significant challenges, and these are the constraints on their growth.
The two biggest constraints are the perception of an innovation gap and the difficulty in executing in new, highly contested segments.
That slower revenue growth, the 9.6% in 2024, leads to a perception of sluggishness.
It does. And furthermore, they face significant execution difficulty in high-growth adjacent markets. Their EDR offering, for instance, faces an uphill battle against CrowdStrike's dominance, and their CNAPP product is battling well-funded cloud-native specialists.
And we saw the evidence of this struggle in their operating margins over the last couple of years.
Exactly. The JAP operating margin compressed to about 14% in FY 2024. This was a deliberate choice. To stay competitive and fund this whole ETM ROC pivot, they had to increase R&D and sales and marketing expenses faster than revenue was growing.
A necessary investment.
A necessary investment to remain a platform player rather than being marginalized as just a niche VM vendor.
So Qualys is in a race. Can their highly profitable centralized platform, amplified by Agentic AI, consolidate customer security spend fast enough to fend off the colossal platform vendors and the aggressive growth peers?
And that competitive race, that internal pivot, it all brings us to the ultimate question of valuation.
Right.
Investment analysis suggests Qualys is currently transitioning in the market's eyes, moving from being seen as a high-growth niche leader to a mature, high-quality platform player.
Let's look at the valuation snapshot. If we look at a DCF analysis from earlier in 2025, how is the market valuing this profile of stable growth and high cash generation?
A discounted cash flow analysis done just before the Q3 update yielded an intrinsic value range of about $115 to $145 per share.
So it was positioned as fairly valued around $126 at the time.
Pretty much. And crucially, the market values Qualys primarily for its profitability and cash flow strength, not its top-line growth potential, and this is evident in its sales multiple.
How does that price-to-sales ratio compare?
Their PS ratio was around 7.6x. This is considerably lower than the multiples often commanded by hypergrowth peers like CrowdStrike, which might trade at 15x or even 20x sales.
But they get a good earnings multiple.
A robust one. A forward PE ratio around 21.7x, which reflects the reliability and efficiency of its earnings stream.
So the investment thesis, before accounting for the full ETM ramp, is essentially a hold. You are buying stable, profitable exposure to cybersecurity with moderate growth expectations.
That's the base case. It's ideal for institutional investors like Terry Smith, who prioritize capital preservation and durability. The financial health of the business provides stability and resources.
So the question then becomes, what are the real risks and potential catalysts that could push it out of that fairly valued range?
Right.
Let's detail the key risks that could derail the ETM strategy or impact that reliable cash generation.
The most significant risk is just a failure of ETM ROC adoption. If these newer solutions or their other modules like Total Cloud or EDR fail to gain meaningful market share or cross-sell effectively, revenue growth could stagnate even further,
Dropping below 5%.
which would severely pressure its valuation multiples. Second is just persistent competitive pressure. If the platform giants succeed in bundling away large segments of Qualys' current customer base, it would lead to continued margin pressure and market share loss, regardless of how strong their cash flow is today.
Okay, on the flip side, what are the potential catalysts that could re-accelerate growth and fully justify that massive increase in Terry Smith's conviction?
The most immediate catalyst would be better than anticipated customer adoption of the integrated TrueRisk platform. If that QLEX pricing model successfully accelerates adoption across their 10,000 plus customer base and delivers on that promised 100% uplift,
Then the NDE rate surges past 104%.
and the growth metrics will begin to turn upward significantly. The other major catalyst would be strategic M&A. If Qualys uses its formidable cash balance to make a large, disruptive acquisition that significantly accelerates its capabilities in AI or XDR, it could provide the market disruption needed to truly re-rate the stock.
So Terry Smith is essentially betting that the strategic shift from niche VM to the integrated risk surface management platform, coupled with continued execution on cash-generating efficiency, provides a durable return stream.
That $115 million commitment is not a bet on hypergrowth. It's a highly confident wager on enduring quality and financial discipline.
So to sum up this deep dive, Qualys is a company defined by some profound contrasts. You have this decelerating top-line growth settling around 10%, yet this is offset by rock-solid, even accelerating profitability and just unparalleled capital efficiency.
That 50% plus operating cash flow margin in Q3?
It's incredible. And this entire stable foundation is being used to fund a massive, high-stakes strategic pivot toward agentic AI risk surface management, spearheaded by ETM and the ROC concept.
And the decisive move by Terry Smith signals that a patient, value-focused investor believes the underlying stability and the potential of that ETM-ROC strategy are worth the increased conviction.
The safety net.
The consistent massive cash generation is the safety net. It ensures durable returns, primarily through share buybacks, even if the promise of market-disrupting growth takes several quarters to materialize.
So the company is essentially betting its future growth on its ability to unify fragmented security tools, consolidate customer security spend, and thanks to ETM quantify risk in clear, undeniable business terms. Their future success depends entirely on making the case that their integrated, single-agent, highly efficient platform is superior to the bundled, often disparate offerings from those colossal platform vendors like Microsoft and Palo Alto Networks.
Which raises a really important question for you to consider as you digest all this information. Given the competitive landscape where hyper-growth rivals are expanding rapidly and giants are bundling aggressively, will the power of Qualys' integrated cloud platform and its early lead in the agentic AI ROC truly be enough to accelerate that challenging 104% net dollar expansion rate to justify the stock's long-term growth potential?
Or is its cash flow permanently destined to be a vehicle primarily for capital return rather than a source of market-disrupting growth?
That's something for you to mull over until our next deep dive.